going into the construction end market and non-residential budgets or plans. More interestingly, though, is if we look at steel consumption and growth over the last 10 to 20 years, it's a double-digit CAGR. Okay, it's like 12%, 11.8. And if we strip out China, growth is relatively flat. It's sub 2%. So China is driving the good part of that growth. I mean, you're in the heat of this. You are impacted by the pricing environment. I'm just wondering if I could get your take, or the audience can get your take on where you think the pricing environment is going. We talked about kind of what's driving it, but where do you think it'll remain elevated within the next 6 months, year? You talked about, the spending holding it up, or when do you think a tempering will occur, if at all?
So what's interesting for us is if you look at the last 10 to 15 years, there's been a pretty dynamic shift in the mill manufacturing business. And again, you'd mentioned iron ore, coking coal. Those were the typical elements that people watch for pricing drivers up until about 10 or 15 years ago with the emergence of the electric arc furnace or the mini mills. China has recently really ramped up their growth in the electric arc furnace and mini mills in the last 3 years, adding more supply of those mills than is in all of North America. So when you look at that, 60% of what goes into their mix to make their product is scrap metal. China now is emerging to become maybe the largest importer in the world of scrap. So it's changing that dynamic. Turkey currently is, but with their appetite for scrap, they're not generating enough, even with their own manufacturing, that they're now starting to be that net importer. That's driving the scrap price up. And we think that's going to set a floor that's been higher than it has historically. So we think there's a fundamental shift there in scrap pricing for the floor. Even as markets move up and down, we think that floor will be higher for the costing analysis. When you look at the appetite that's out there for scrap, it's really, a lot of it comes off of the automotives, but a lot of it just comes in from basic scrap yards that are out there. So again, China just does not have enough to feed themselves. And again, you're correct. The rest of the market is not growing, where China has been. When we talk about other things that are out there, the initiatives that are out there right now to shift from energy and how those affect it. Even if we go to solar, we go to wind, we're not going to get away from the traditional energy anytime in the next decade or so. So all those are good for Russel. Again, those are all steel driven. So we're very happy with that. And the new grids that are required are steel driven. So we think that can be beneficial for our service centers as well. So we see a lot of demand drivers that are out there for our business, as well as a bottom coming up that we think it's just going to be higher for longer than we've seen.
Yeah, no. And I believe, I'm not sure, but you can correct me if I'm wrong. I believe there were some restrictions on scrap metal being brought into China that were recently lifted. So there was some definite pent up demand there that was not satisfied for a period of time. And so that's also contributing to the price escalation. Would you say that's?
Yeah, it's going both ways. There are also restrictions on China exporting, and so now that free trade has opened up more so. So again, I think that market will open up, but again, the demand out there for scrap is growing dramatically, really on the back of China.
Perfect. Thank you for that insight. It's always good for me to hear. You can read as much as you want about steel and China and all the supply and demand, but it's good to hear it from someone that's in the mix of it. So I just wanted to turn a little bit to margins. And as a distributor or intermediary, initially I didn't think, and I'm relatively new to the name, I launched just last year, I didn't think that margins for you guys would be so positively impacted by the pricing environment. Just wondering if you could speak to how these macro tailwinds are flowing through to you guys. And additionally, if you wanted to, I don't know if this is the time to comment on it, but your shift a little bit to more value add offering. And I know that has had a direct impact on the average transaction price. So just on the margin side and how things have been impacted there.
Yeah, and I think we've talked about it before, but for the broader audience, we're 95+% transactional in what we do. And if you think about Russel in terms, we have 40,000 active customers. Our average order size is just under $2,400. So we're doing a lot of small transactions on a daily basis. And with the fact that that's transactional, not contractually bound, it really affords us the opportunity to move those margins in very quickly in an uptick in a market. Typically, the market's going up because demand's tight, supply is tight, and so we're able to really push those margins, our gross margins, into our sales channel very quickly. We've got a group of highly motivated salespeople. Again, they're paid off of variable compensation based on how they perform on profitability. So they're they're really incented to do that, and we take advantage of that when the market's in our favor. Just shifting over to the value added that you mentioned, again, doing the high end value added tube lasers, flat lasers, we're really going in and making component parts that's moving us down the value chain, and vertically integrating, where we're taking parts from our customers' shop floor, where they may have bought the steel in the past, then 2 or 3 processes inside of their plant, or they may have bought the steel from someone like us, sent it out on 2 or 3 other purchase orders to be processed. We're now doing all of that in-house. And what that gives us is a component of labor that is involved. It's becoming a higher and higher component of what we're shipping to people. And so that becomes a fixed number. And so steel may move up and down with an index where people can watch the steel pricing move up and down, but this really takes us a little bit away from being a commodity and makes it a more sticky margin that stays with us. If you look at our 2020 service center margins, gross margins held around 21%. Historically, when we've seen downturns this magnitude, we would fall in that 16, 17% range. So it's really been sticky for us. We're seeing paybacks on these projects in 2 to 3 years. And we've developed a hub and spoke concept that now we've developed the hubs, we've developed the engineering background where we can reverse engineer parts. So it's really allowed us to start pushing these into the spokes. And we should be able to ramp this up over the next 2 to 3 years and really potentially double our output and what we're doing with value added.
Perfect. So there is room to grow then, if I'm reading between the lines, from the 21% gross margins on the service side of things. Is that correct?
If you look at Q4, we were already at 25. And if you go back and if you track us historically to plate and flat roll, you can see kind of how our EBIT margins follow along, but our margins typically go up in an increasing market. Again, we'll push the pricing through first and try to be a leader.
Okay. And then, so really this value add offering, I think to me as an investor, you want downside protection. So it's a risk mitigation also. And then I think it smooths the financial performance, as you talked about, that in a down cycle, you would see potential 300, 400 basis point contraction, but it held in. So would that be a right characterization as what it brings to the table?
Yeah, it gives us some normalizing of that. And again, like you said, that downside mitigation is there. So, and we really, for us, this going through this first down cycle, we actually saw growth in that as people were able to lay off some of their workforce and shift work over to us. And so we're continuing to retain that work. So we're very pleased with it.
Perfect. Thank you. And just as a follow-up to that margin side, when the pricing environment tempers and prices start to decline, I know you have this value add offering that's going to provide, a cushion, but just wondering if you could share with the audience what kind of contraction could we potentially see? I know you spoke about that 300, 400 basis point. Just trying to get a feel for the dynamics as the mix of the business has changed even over the last couple of years.
So in my 30 plus years in the industry, yeah, we've seen some wild swings and slow swings. So we really predicting that we have a hard time doing. Frankly, we're not very good at it. So so what we've done to really mitigate that risk from Russel's side is we turn our inventory faster in Canada and faster in the United States than our competitors. We're 6+ turns in a normal market condition in the US. We're 4+ turns in Canada. The difference is really logistics, because some of the products are just not made in Canada, and the in-transit timing of having it on rail or on the water to get it into Canada. Counterintuitively to some is that actually in a period like this, when we're seeing the price rise environment, we'll actually turn our inventory faster. And so we might lose a little bit of holding gains there, but we're preventing from the downside risk. And again, we'll get the steel and the product we need because of our scale to our balance sheet. And so we'll get the product that we need and work very closely with our mill suppliers, but we'll actually improve those turns in anticipation that at some point there may be some downside risk, and we want to get to the bottom first in the pricing.
Okay, no, that's very helpful. Thank you. And now I'm just going to talk about, we delved a little bit into the changing mix with the significant slowdown in demand on the energy side. You were very proactive in your approach to reduce your footprint in 2 key areas on the energy side. One was line pipe and one was OCTG. I'm just wondering if you could provide some color on what drove the decision. There is some capital reallocation as a result of the decision. Where are you in the process at this point in time?
Yes, our initial decision process, as we looked, there were really 2 or 3 factors that we were seeing out there. First, we started to see the mill manufacturers in some instances start going direct around distribution. And that was squeezing the margin profile to where it was really becoming difficult over the last 3 to 4 years to make an adequate return for the risk you were carrying on inventory. So we were seeing mid to low single digit returns in the OCTG and line pipe area. In addition to that, you saw Japanese trading houses starting to buy up roughly 50 to 60% of distribution in North America. So they had obviously a lot of buying power, and that continued to put pressure again on the margin profile. And so those things alone really had us stop, sit back and look, is this where we want to be, considering we have a 15% threshold for return? Our service centers hit that over the cycle. Our distribution hits that. In addition to that, seeing that the new green initiative that's out there, seeing the pullback that was forthcoming with energy, I don't think we'll ever get away from energy there, but it's definitely going to reduce the footprint, whether it's solar or wind power, car batteries. And so we think that will change that dynamic. So we started executing early on. Our goal starting in July of 2020 was to take out $100 million for the capital. By the end of 2021, I think we'll far exceed that goal. In the first 6 months, we took out over $65 million. We have started an orderly liquidation process of our U.S. operations in OCTG and line pipe. Really waited on the timing when we started this initiative to say, okay, if we see a run up in price, we can get out of the market relatively unscathed when it's profitable for us. We didn't buy any new inventory. Our existing inventory was at the low price, so we're having a very good run with that inventory right now in this inflated market for their side. And we merged our Canadian operations where we had one OCTG and one line pipe. We merged those. We centralized our back office. We centralized our sales. And so we lowered our cost footprint there. We also restricted the capital that can be spent. So again, if there's an opportunity to exit in that, we would definitely sit and listen to that and take a good look at if it's something that's feasible for our company and our shareholders. But it's not something long-term we see invest in the capital. The repatriation of the capital we're getting from that would go into our service centers, into our value-added processing, potential acquisitions. We'll have dry powder available to do really anything that we see on the service center side that can allow us to continue to grow at above that 15% return threshold for our shareholders.
Okay, thank you. And I'm just wondering, even within the organization and the structure of it, are those decisions typically, I mean, it's a C-suite decision at the end of the day, you're pulling the trigger, but in your, 30 plus years of experience, oftentimes are ideas brought up from someone that's working within that or saying, hey, we're not making the money here, or our inventory price is quite low right now in this product category, maybe we should offload that? Or is that really just kept to the high level of management?
Yeah, and as you know, we run a highly decentralized model. And
that's
so,
what I'm asking. Yeah, that's what I'm asking.
So I spent a lot of time with our executives that run our OCTG and line pipe divisions. We looked at different ways to run the business since 2018 forward, how we could turn our inventories better. Again, there's just not a lot of levers to pull in that business because it's really just a stocking locations. It's your third-party yards, and so your inventory and receivables are really your two options. And we just really couldn't come up with a way. And again, I hate it from the personnel perspective. It's not something we want to do, but we just didn't see a way to change our business to make it more palatable to where we could achieve the returns. And so we felt like it was a better use of shareholder funds. If you look at the corporate level for myself, Marty, at the C-suite, we're really a bank that knows the business, and our job's to allocate the capital appropriately. So we made the determination, met with our board, went over our strategic plan, and the board agreed with it. So we began to execute on, again, just a very orderly liquidation type format.
No, thank you for sharing. It's just nice to know from myself and even the audience, the different types of, structures and how decisions are made internally that we typically don't get that insight into. So thank you. Maybe we could just discuss your end markets and key customers right now. Very basic, like who's buying your steel. I know you said you're very transactional. You have over 40,000 different customers. Have you seen any shifts or changes in the end market over the last, 5-10 years? And do you expect the structure of the business to continue into to remain the same over the next so many years, or do you expect that mix to change?
Yeah, so, and again, you hit the nail on the head. We're so transactional. I mean, we don't have any customer that represents more than 3% of our overall business. And so we have again, very decentralized customer base that's out there as well. But what we've seen over the last 10 years is the move towards more of the value-added processing, and it just continues to evolve. We started on this back before I was even purchased with Russell with the value-added process, and we've continued to grow, and Russell's really embraced it and grown with it as well. So when we look at that, we see that as kind of the next wave, and you could move into robotic welding, move into other opportunities that are out there as we go forward. But what we're seeing is more people looking to the just-in-time inventory, looking for you to do inventory management programs for them, to where you're the, as you mentioned earlier, an intermediary for the mill timing. It's plus or minus a couple of weeks on a rolling schedule. And so for us to be able to manage inventory at the right place at the right time to help them manage their working capital as we manage our own, and then to start moving downstream to where we can do the value-added processing that we become, again, taking out a step for them that was in the process, making them more streamlined where they're ready to go straight from our truck in an orderly packaged fashion to a manufacturing line. So we see that we'll just continue to grow closer and closer with that customer base, where 15 years ago we were just distributing steel, and then we started making some parts, and now we're actually making finished kits and finished weldments for people.
Sorry, this isn't just going on that topic, but is personnel, do you have a hard time finding personnel within the end markets? I know some of the locations are, I don't want to say remote, but not in key large urban areas. Is that, I know with the value add processing, the human aspect of it is integrated within that. So just wondering if that is a bottleneck, if at all.
Yes, I think personnel is a challenge right now, North America wide, to find plenty of personnel. We are in very remote markets as well as large metropolitan areas. Again, we found that if you have a reasonable compensation plan and you're paying people well, you don't have too much trouble finding people to come in. Training people for this. The beauty is, once we have the hub, if we're going to move this out into those remote areas, into a spoke area, we'll send them to the hub for a month to train. And so we'll identify the employees. These are usually higher paying jobs for our employees. And so they again, we like to promote people that have already been with us, that have the aptitude to move into those jobs. And so they get the opportunity to make more money. So they pretty keen to move over, train. COVID's made that a little challenging, obviously. But again, we can do a lot of the training online, and then they can go in and learn how to run that equipment from the actual hub itself, which is usually in a larger metropolitan area.
Okay, no, thank you for that. This is just more of a fun question, but if you were going to pick out someone within the organization and ask them, how would they describe the culture? What do you think are some words that would come up?
Yeah, well, I think, when you really look at our culture, what you're going to hear is entrepreneurial. And we try to set this up as a public company. We set the rules and the framework of a public company, if you will. We define their sandbox, but we let them play within it, and they do their hiring and firing. They do their buying and selling. We are a support. The corporate office is a support to the field, and we offer professional HR services, professional legal services. They use us as they need us, but they run their business day to day, and we allow them to make decisions in those local markets. So again, they run. This is as close as being a former business owner. I can say this is as close as I think you can get to an entrepreneurial culture being in a public company without being an independently owned business. So our people take a lot of pride in what they do because of that. And so again, they're allowed to run that business and make those critical decisions for us.
Okay, thanks. And then just now turning to M&A. And sorry, I just want to check and let the audience know, please don't hesitate. We want to have audience questions. We want this to be a bit interactive. It's not just me and John up here, so please don't be shy. Raise your hand, or if you're a little bit shy, camera shy, then you could type your question in the chat specifically to us or everyone else in the panel as the audience member, sorry. So just turning to M&A, what can investors expect with the M&A strategy going forward? You did close Sanborn, which was in Wisconsin, in December. Where are other low-hanging fruits? Do you have a pipeline of targets at this point? Or the pricing environment you're waiting to temper before pulling the trigger? And what kind of growth can investors expect from M&A? Is it kind of tuck in smaller side? And I'll just leave it there for the M&A side. I'll leave it open-ended so you can put in whatever you want.
So yeah, just to touch on Sanborn, we were looking at putting in a value-added processing hub, as we've talked about on the call. Sanborn was actually a customer and a supplier for us. The owner was ready for retirement. He was 65 years old, did not have anybody in his family that wanted to run the business. So it was just a very natural bolt-on fit right within 20 miles of our Milwaukee, Wisconsin facility. So he was running about a shift and a half operation. 3 months later, using our sales network and that's out there to broaden his reach, and using our distribution network through our trucks. He's now running 2.5 shifts, soon to be at 3. And we're probably going to be adding on to that facility and adding equipment within the next, 6 months. So it's been a really nice fit for us, and it's performing exceptionally well. When we look at M&A, we're highly disciplined. And again, you've got to be careful in a peak market. If you pay a peak price, it only performs at the threshold and the hurdle you want in a peak market. So we really look back at the last 5 years and say, how's the business performed over the last 5 years? If you have a very strong year, if 2021 plays out to be a strong year, that neutralizes the 2020. And so we look at that and say, how do they perform over a cycle, not just in good times or not just in bad times? When we evaluate it, we also look at the culture of the business. Does it fit in our decentralized model? Do we have to parachute in management? Typically, we get 1 to 2 turns out of the multiple, or 1 to 2 times, I'm sorry, out of the multiple from turning our inventory faster. We typically improve the operating cost, 1/2 to 3/4 of 1%. So those are things we can bring to the table. But talking about the pipeline that you mentioned, we've seen a lot of activity lately, and there's if you look at the top 10 service centers, we probably have less than 15-20% of the overall market in North America. So there's a lot of opportunities with privately owned or smaller companies, a fair amount in that $250 million range and below. And then there's, I think, 11 of us at $1 billion and above. So there's a gap in the middle, and that's kind of been hollowed out, if you will. There's only a handful of people there. So we'll continue to look at M&A. Again, we're the capital that's coming back from OCTG and line pipe. But we'll continue to take a real disciplined approach to make sure that we're going to meet those hurdles and those thresholds. We don't want to just get big to get bigger on the top line. And so we wanted to make sure it's doing the right thing for our shareholder, that they're seeing that return of 15% or better.
I know, thank you. And then you had mentioned that Sanborn was a customer and you had a relationship with them going back years. Was that company that you had identified this would make sense for us to own, and given the proximity to your other facility? And how long did you approach them, 1 year before the transaction and say this would make sense potentially, or did it go further past that?
So, and back to a previous point you made, again, running these decentralized models, running the entrepreneurial culture, our regional manager from Wisconsin had talked with them for years. If they ever wanted to sell, we'd love to talk to them. That came to fruition. They actually went through a process. The banker approached us. We met with them. And we've got a pretty small group that comes in when we do that. Marty, myself, and a couple more from corporate, along with a regional manager. And we sat down and we're able to work something out very quickly. So usually the genesis of a deal for us comes from the regional management.
Okay, thank you for that. Sorry, I had to pause my video. My iPad was dying, so I had to plug it in. Long day of here with the fireside chats and presentations. Okay, no, that's great. And so would you say, sorry, just one more last thing on the M&A side, would you say even now you're getting calls in, or is it you guys having your targets and you're calling out?
Yeah, the call activity coming in, the books coming in from the investment bankers is definitely ramped up. We're still continuing to call out. Again, being 31 years in the industry, I've known a lot of people over the years, and so we stay very close to potential targets that fit. But the call volume inbound right now is really ramped up.
Okay, no, that's good to know. End market indicators. So we talked a little bit about what was driving the price environment, but we all like to try to figure out how the financial performance is going to come before you report. What are different indicators that you track on your side, and that we could track, or different sources of information for the sector that you think are valuable?
So if you look on a macro level, we're going to watch, obviously, the scrap pricing. We're going to watch GDP is a very big indicator for us. We tend to follow GDP. Steel pricing is a very important factor for us for both plate and coil because it touches so many products. Oil pricing, rig counts are very important as well because, again, the oil business uses a lot of steel and their infrastructure spend as they're building platforms and different things. So really those, when you look on the macro level, those are important, and also lead times at steel mills. When you get down to the micro level, again, it becomes very regional for us. And so who are their players within their region? Who's busy? Where's the market shifting to? So they will work closely with those individual regions that they operate in and again, having that sales desk there in that region, it works very closely with those people that they can hear what's growing, what's hot, and what's not. So we really work on both levels of that to see what our market's doing. We may be very busy in Quebec and we may not be so busy in Georgia, but we know that from the regional. The nice thing is we have 126 test tubes. So if 124 are going up and 2 are going down, we know we've got a problem. If we see a mixture of all of it, then we know there's different things going on in the market.
Okay, thank you. No, the good insight. And just, I wanted to turn to ESG. It's picking up. We have a lot of investors that care, over 90% of investment decisions factor in ESG criteria. I imagine we had a construction panel earlier today that said we are, the end customers are very price sensitive and don't really, discuss any ESG, care about our ESG initiatives or, how we're doing internally. And then I just had a panel with consultings and engineering companies, and they said, it's definitely coming into discussions. We have 30 minutes to pitch a product, and majority is spent on what we're doing on the ESG front. I imagine, given you're highly transactional, that ESG is not really coming into discussions on the end market side. But I would assume that definitely on the investment side, it's picking up steam. So I know I've talked to you, Marty, about diversification. I know you have some initiatives with even hiring women, school scholarship programs. Just wondering if you could talk about your ESG positioning, how it has evolved, and just any areas that you wanted to touch on or highlight for the audience.
Sure, and really ESG has been kind of the DNA at Russel since the day I've joined, and I've been very impressed with what Russel's always done there, really from our board level all the way down to our shop floor. And so if you look at our company, if we take out the plant operations, which is a very physically intense workload, can be a little bit of a dirty environment when you're dealing with steel. If you take that off the table for just a moment, we're roughly 50-50 on gender diversity inside of Russel today and have been for quite some time. If you look at our C-suite, it's around 30%. Our board of directors, we have 2 new directors will be joining in May. We'll have actually 3 ladies that will then be on our board. We have good also diversity and visible minorities that will be on our board. And so it's been something that, again, has been there since day one. So we think it's very important. If you look at our shop floor, we're almost twice the industry standard. And so again, we're excelling that in that comparison. Our industry is a little bit behind the standard, so we need to do a better job. But we're very involved with the American Women in Metals Association, that we've just joined their national level to be one of their platinum sponsors for them. And we recommend several of our people to go to it. Our director of HR, Bev Downer, is actually leading an initiative for us on the Metal Service Center Institute, where we're also on that board and that trade association, where she's actually leading a format to really work with the diversity inclusion to set a standard for our industry. We also have another person working to set a standard for ES&G for our industry. So we're trying to be out on the forefront of that. The most challenging thing for ESG for us, it's not like accounting. You have a GAAP standard or you have an IFRS standard. There is no standard for ESG. So you get investors that have different opinions on what those standards should be, and how to communicate that can be challenging here initially. So we're looking forward to kind of coming up with a standard format, because we think we do very well. When you look at the environmental side, our carbon footprint is so low, it's not even really on the radar screen for the foreseeable future. We're so far below any government thresholds. Our biggest emissions comes from diesel trucks. We don't actually make steel. We do some processing with it, but again, so it's a very strong ES&G environment that we're very proud of. So we look forward to that being an initiative that's out there, and we understand the ground rules, if you will, for what needs to be defined, because we think we're very strong in that area.
Okay, perfect. Thank you. And we are coming up on the time. Julian, do we have any questions from the audience?
Nothing yet from the audience. Mona.
Okay, guys, don't be shy. I'm looking at you. Come on. I guess I'll kind of wrap up a little bit with a couple questioning. Vision. You've been in the industry for over 30 years. what is your vision for Russell, whether it's 5 years or 10 years down the line, or even more than that? I know it's the end market, metals distribution, processing, very fragmented. There's like so many small mom and pops all over the place. You mentioned yourself that if you look at the companies that are doing over $1 billion in revenue, it's, a handful, like 2 handfuls, 10. So do you see yourself, increasing your positioning via consolidation slowly? Is it really a margin focus? Just, anything to give some insight as to what we can see from Russel Metals down the road with you leading the way.
So I think you'll see growth in the U.S. market. Obviously, we're a 70-30 split Canadian U.S. We're number one in every market we serve for the most part across both U.S. and Canada. We're just very small in our U.S. footprint at this time. And so we have a much bigger playground there. So our targeted growth would be there, but we won't force it. What we're really after, though, is again that we want to be a leader in market share in the markets we're in, but we also want to be the industry leading in returns. And so again, our growth is geared towards those. I mean, there's some competitors our size that we could go out there and buy, but we wouldn't do anything but get bigger. I don't think we would do anything for our shareholders. We would hurt our return level. So again, we're going to be very patient at what we do, but also we do have an eye towards growth. We're solidifying that balance sheet. As we continue to move away from the OCTG and line pipe arena, we'll continue to solidify that. So again, we want to see a bigger, stronger company as we go forward. It is a great place for our people to work.
Perfect. And is there anything that you want to leave the audience with as a key takeaway, or any final remarks?
Yeah, just again, and we touched on it, but as we move into 2021, we think this is a change. It's different than what we saw with the financial crisis, or different when we saw the downturns back in 15, 16. Those were an event that came off of a high price. These are actually coming off of an event leading to high prices. But there are some structural changes we see in the marketplace. So we think that we're going to see pricing higher for longer in this marketplace, and we're very encouraged about 2021.
Okay, thank you for that. Julian, is there any more questions? No more
Still
questions?
nothing.
Okay, that's fine. I'm going to ask one more because we still have time and I want to learn. So, so we talked about the vision and market indicators, mix of business. So, you talked about growth a little bit more in the US. But do you think the vertical, like the split that we're at right now, I know you're increasing exposure on the energy side. So after that is kind of concluded, do you think that the mix for the metal services centers will remain the same, or could we see greater growth on that side, or even the steel distributors, and whether it's mixed by a vertical or geography or end markets, just anything there?
Yes, I think the answer is yes. It's I mean, when we bought Apex, we'd never heard of them, and they came across the wire, but that was a vertical we weren't in with the valve fitting and flanges. And so as we look at other verticals that are out there, as long as it's in distribution and something that we feel like we understand, where it's a working capital business and not counterintuitive to what we already do, then that's something we would explore. Our inventory mix is very strong right now in the carbon side, but I could see us getting into the non-ferrous side, the stainless and aluminum, and growing that vertical as well. And then continuing on this value-added processing road, we think there's a lot of leg left to run there. So we'll continue to run that out. And as far as geography, we want to make sure that it fits in. If it's a standalone operation, we don't want to get something too small that's out by itself where we can't leverage our other opportunities to work with our other service centers. But again, the bolt-ons will come. And if we saw something that was large scale, we've got the balance sheet in place to do pretty much anything we would need to do right now.
Do you think, I mean, this is a bit of a stretch, but sometimes we see some of the companies that I cover, or even their comps, are primarily North American based, and then there's an acquisition in Australia. That's the same business that they're doing, and then they just make the jump. Would you ever think to expand the footprint outside of North America in time?
Yeah, today, we're a North American based company. Would I say we would never do it? No. We could consider it, but it would have to be a pretty compelling reason for us to go across the pond. Right now, there's just so much opportunity for us still within North America to double the company or more in size that I just don't see us stretching out that far anytime in the near future. Again, if the right opportunity comes across tomorrow and it's very compelling, we will take a look at it, though.
No, it's just good to know. You never know, right? If I don't ask and then you do an acquisition in God knows what country, and I'm going to be like, I never asked that question. So, no, it's good to know. I continued my learning on the name. I have tons of notes. It was very exciting. Thank you for your insight. Thank you for your time and availability today. I've thoroughly enjoyed it. And thank you to the audience for joining. Please join us tomorrow for our third day of our annual conference. We have an exciting day with Nick Agostino leading off our technology day. So please join us tomorrow. Thank you, guys. Thank you, John. I really appreciate it.
Thank you, Mona. Take care.
Bye.